6 times in his life, Warren Buffett watched the United States go to war. Korea, Vietnam, the Gulf, Iraq, Afghanistan, and then the economic war of COVID that shut down the world in 2020. And 6 times, while every headline was screaming panic and every financial advisor was telling people to be careful, Buffett did the same 4 things with his money. Not approximately the same, not sort of similar. The exact same 4 moves documented in his shareholder letters, confirmed in interviews across 7 decades, repeated with enough consistency that if you know what to look for, the pattern becomes impossible to miss. The uncomfortable truth about wartime money decisions is this: every instinct you have about what to do when a country goes to war is designed by evolution and by media to make you poor. The instinct to move to cash, the instinct to wait until things settle down, the instinct to sell before it gets worse, these feel like protection. What they actually do is lock in losses and guarantee you will miss the recovery that comes right behind the fear. Buffett understood this about human psychology 60 years before most people had even heard of behavioral economics, and he built his entire approach around the fact that mass panic is not a warning. It is a schedule. He knew when the discount was coming before the discount arrived. During the Korean War in the early 1950s, the Dow dropped sharply and most investors pulled back. Buffett, 20 years old and armed with Ben Graham's framework, was looking for things to buy. During Vietnam, as markets became deeply volatile through the late 1960s, he quietly accumulated positions in companies that the war had made unfashionable. During the Gulf War in 1990, the S&P 500 fell 18% in a matter of weeks. Buffett deployed capital. After September 11, 2001, when the market dropped 14% in 5 trading days, the worst single week in the history of the American stock market at that point, Buffett was reading annual reports and looking for opportunity. During the long years of Iraq and Afghanistan, while fear kept most retail investors frozen or moving to the sidelines, Buffett expanded his core positions and made some of his most consequential purchases. And in 2020, while the country was locked down and markets were in free fall, Berkshire Hathaway was sitting on the largest cash reserve it had ever held, not by accident, but by design. The reason most people miss what Buffett was doing during these moments is that the financial press was not covering it. The headlines were about the war, the casualties, the political implications, the economic disruption. Nobody was running a story that said, "Warren Buffett is quietly buying right now." He was not announcing it. He was not posting about it. He was reading balance sheets and making calculations. And by the time the public understood what had happened, the window had already closed and the positions had already been established. What makes this pattern worth studying is not that Buffett got lucky across 6 different conflicts spanning 70 years. It is that his behavior during each crisis was methodical, purposeful, built on a framework that he developed early in his career and has never fundamentally changed. He was not reacting to each war individually. He was executing the same playbook, adapted to each situation, but rooted in the same 4 principles. And when you understand those 4 principles, the chaos of wartime markets stops looking random. It starts looking like opportunity. If this way of looking at financial history is opening something up for you, subscribe to this channel right now. This is where we break down how the financial machine actually works, not what the news tells you, but what the numbers show. The paradox at the center of all of this is the following. War creates the specific conditions that Buffett's approach was built to exploit. Not because war is good, it is not, but because concentrated, widespread fear creates a gap between the price of an asset and the actual underlying value of that asset. And that gap is where Buffett has made his career. Every time America went to war, large numbers of investors sold things they should have kept. The prices of those things dropped. The underlying businesses did not change. The gap opened, and Buffett walked into it with intention. The market data across these 6 periods tells a story that gets cleaner every time you look at it. During the Korean War, the Dow Jones eventually rose significantly over the course of the conflict. During the Vietnam era, despite the chaos and uncertainty that defined the late 1960s and early 1970s, companies with strong fundamentals continued to compound. During the Gulf War, the market fell 18% and recovered all of those losses within 12 months, then continued higher. After September 11th, within 1 year, the market had fully recovered from the attack. During the Iraq War, from the initial invasion in 2003 through the following years, the S&P 500 produced strong returns for investors who held through the fear. And 2020 produced the fastest bear market and the fastest recovery in American financial history. The pattern is not that war is good for markets. The pattern is that fear creates a window, and the window closes. Buffett was 20 years old when the Korean War began. He had been studying Benjamin Graham's work for 2 years. He already understood in theory the concept of buying $1 of genuine value for 50 cents. But Korea gave him his first real laboratory, an actual period of public fear when stocks were trading far below what any rational analysis of the underlying businesses would justify. He did not develop his wartime investment philosophy in a classroom. He developed it by doing it, starting in 1950, in one of the most charged geopolitical moments the country had seen since World War II. The confidence he would later project in every subsequent crisis was not theoretical, it was earned. Pay attention here, because this changes how you see everything that follows. Buffett was not fearless during these moments. He has said explicitly that he reads every piece of bad news carefully and takes it seriously. The difference between him and the average investor is not that he feels less fear. It is that he has a framework that tells him what fear actually means in financial terms. And that framework says the same thing every time. Fear is a signal that the panic premium is open. If this is landing with you, if you can feel the shape of what Buffett understood that most people do not, write in the comments right now, "I buy when others panic." That is not just a quote. It is the foundation of everything that follows. The first question most people ask themselves when they watch a crisis unfold, when the market is dropping and the news is dark, is, should I move to cash? It is the most natural question in the world. Everything feels unstable. Cash feels solid. It has a number attached to it. That number does not change. It seems like the right protective move. Buffett has an answer to this question, and it is one of the most counterintuitive things he has ever said. The moment most people move to cash out of fear is often the best moment in years to be doing the opposite. The first thing Buffett did every single time America went to war was scan the market for companies whose prices had dropped well below their actual worth. Healthy businesses with strong fundamentals caught in a wave of indiscriminate panic selling. He called this the hunting ground. The broader financial community has come to call it something close to what he described, the panic premium. The premium is this: fear makes other investors pay too high a price to get out quickly, which means the person on the other side of those trades is getting an extraordinary discount. The premium does not go to the person who panics. It goes to whoever doesn't. During the Gulf War sell-off of 1990, Wells Fargo was trading at approximately 5 times earnings. 5 times. For context, a healthy bank in a normal environment would typically trade at 10 to 15 times earnings. The implied message of the market price was that Wells Fargo was barely a viable business. Buffett analyzed the loan book, the customer base, the underlying franchise. The business had not deteriorated to anything close to what the price was suggesting. What had deteriorated was sentiment. And sentiment, as Graham taught him 40 years earlier, is not the same thing as value. Buffett bought approximately 10% of Wells Fargo during that period. Within a few years, the position had more than doubled. The recovery math on Wells Fargo during that period illustrates the panic premium in clean terms. Investors who held through the Gulf War panic, who refused to treat fear as a signal to sell, watched that position compound significantly over the following decade. Investors who sold at 5 times earnings locked in a permanent loss on an asset that the underlying business did not justify. The panic premium is not a theoretical concept. It is a documented transfer of wealth from people who respond to fear to people who respond to analysis. In the late 1960s, as Vietnam dragged on and confidence in institutions began to erode, Buffett was accumulating positions in companies that the war had made deeply unfashionable. Washington Post, GEICO, American Express. None of these were popular trades. The news around each of them and around the general market was uniformly negative. Buffett's response to the negativity was to read the annual reports more carefully and determine whether the underlying business had actually changed. In most cases, it had not. The war had changed the sentiment. The sentiment had changed the price. The price had created the panic premium. He bought. The panic premium works like a mechanism that most people accidentally trigger against themselves. When fear spreads through a market, even rational, sophisticated investors begin selling things they would not sell under normal conditions. They need liquidity, they want optionality, they move money to the sidelines. In doing so, they sell good assets at reduced prices alongside the bad assets they genuinely should sell. The investor who shows up with capital and analytical clarity walks away with assets trading at a fraction of their intrinsic worth. It is not magic. It is not luck. It is the direct financial consequence of other people's fear being more powerful than their analysis. Now, the panic premium only works if you have something specific already in place before the panic arrives. And this is where most people fall short. Not because they don't understand the principle, but because they have not built the infrastructure that makes the principle actionable. Why does one of the most successful investors in history, a man worth north of $100 billion, consistently hold more cash than almost any major fund manager on earth? Financial journalists have been asking this question about Buffett for decades. The answer most people expect is the defensive one: to protect against losses, to maintain stability, to avoid the volatility of being fully invested. Buffett's actual answer is the inverse of all of those things, and understanding it changes how you think about money permanently. The second thing Buffett did every single time America went to war was maintain what functions as a cash moat. A deliberate, structurally maintained reserve that was not there to protect him from downside. It was there to fund offense when the panic premium opened. Buffett has said in multiple shareholder letters that Berkshire will not allow its cash and equivalents to fall below a specific minimum, not because of fear, but because of opportunity readiness. Cash in Buffett's framework is not a defensive asset. It is ammunition. It exists to be fired when the moment is right. And the right moments, in his experience, consistently arrive during exactly the kind of events most people want to run from. The numbers make this visible. Entering 2001, before September 11th, Berkshire held approximately $36 billion in cash equivalents. When the attack happened, and the market plunged 14% in 5 days, Buffett was not forced to make decisions under duress. He had already made them. In 2007, entering what would become the most significant financial crisis since the Great Depression, Berkshire was again holding an outsized cash reserve relative to the market. When Lehman Brothers collapsed in September 2008 and the credit markets froze, Buffett deployed $5 billion into Goldman Sachs in a single transaction within days of the collapse. Then $3 billion into General Electric. These were not fast reactions. They were the execution of a plan that had been in place for years, funded by a cash reserve that existed for exactly this purpose. If you are sitting with this and thinking that it sounds good for someone who has $30 billion to spare, that is worth examining carefully. The principle scales. At every level of income, the question Buffett's behavior asks is the same. Do you have enough liquidity to survive 12 months without being forced to sell your investments under pressure? Not to be comfortable, not to feel safe, to be structurally capable of going on offense when everyone around you is being forced to retreat. If a crisis arrives and you do not have that buffer, a downturn does not present you with the opportunity Buffett captures. It presents you with the emergency everyone else is already in. The panic premium is only available to people who do not need to be sellers when prices are low. The other thing the cash moat does, and this is the part that is rarely talked about, is protect you from the behavioral trap of needing to make decisions under financial pressure. When you have no reserves and the market drops 20%, you are making investment decisions while simultaneously worrying about your own liquidity. That is one of the worst mental states in which to make clear, analytical decisions. Buffett has the luxury of being calm during crises, not just because he is disciplined, but because his financial structure gives him no reason to panic. The cash moat is partly structural and partly psychological. Both parts matter equally. Building the cash moat does not require a dramatic overhaul of your financial life. It requires one decision made consistently over time. Before you deploy capital into any investment, you maintain a floor of liquid reserves that does not get touched. Buffett's language for this is that cash gives you the ability to act, not the obligation to act, the ability. You maintain that ability during the quiet periods, so it is available during the loud ones. Most people do the opposite. They feel fine holding cash when things are calm, then spend it down or invest it aggressively right before the fear arrives, which is precisely when they need it most. If this is clarifying the shape of Buffett's system for you, hit the like button on this video. It tells me this work is worth continuing, and it helps more people find it when they need it. The third thing Buffett did every time America went to war requires understanding something about why wars are economically different from recessions. In a recession, the underlying demand in an economy contracts, businesses slow down, consumers pull back, the whole system compresses. In a war, especially a major sustained conflict, the dynamic is almost the opposite in one specific sector, the physical economy. Energy, materials, transportation infrastructure, agricultural supply chains faces increased demand precisely because military operations consume enormous quantities of all of these things. That is the obvious layer. Buffett's insight goes deeper. The third thing was building or maintaining what functions as a commodity position, exposure to the physical, real-world assets that every modern economy requires to function, regardless of the geopolitical situation. His reasoning was not primarily about wartime demand spikes. It was about what happens to paper assets, cash, bonds, dollar-denominated investments, when a government funds a major military conflict. And the answer, historically, has been consistent. Governments print money to fund wars. Every major 20th century American military engagement came with significant monetary expansion. When the supply of paper money increases and the supply of real commodities stays constrained, the purchasing power of the paper declines relative to the physical goods. The commodity position is not a bet on the war. It is a hedge against what funding the war does to the currency. Between 2003 and 2008, as the Iraq and Afghanistan conflicts consumed hundreds of billions in government spending and U.S. money supply expanded significantly, oil moved from approximately $30 a barrel to a peak of $147. Copper tripled. Agricultural commodities doubled. These were not war demand spikes in isolation. They were the expression of monetary expansion meeting commodity supply constraints. During this same period, Buffett held a significant position in PetroChina, the Chinese oil company, which ultimately returned approximately $700 million on a roughly $400 million investment. He has been explicit that the position was not a bet on oil prices specifically. It was a position in an asset that would respond well to exactly the kind of monetary environment that wartime government spending reliably produces. This is not a sophisticated move that requires special access. A position in a commodity-heavy ETF, an energy company with strong fundamentals, or infrastructure assets that serve the physical economy. These are all expressions of the same principle at different scales. The point is not to speculate on oil prices. The point is to hold a portion of your wealth in assets that respond positively to the monetary conditions that wartime spending reliably creates. In 2009, as those wars were winding down but the physical economy was becoming structurally more central to American supply chains, Buffett made the largest acquisition in Berkshire's history, Burlington Northern Santa Fe, the railroad, for $34 billion. Railroads move coal, oil, grain, chemicals, and industrial materials. They are the arteries of the physical economy, the infrastructure that moves the real things that power the real world. It is the same commodity position principle expressed at infrastructure scale, not paper, not financial instruments, real assets that move real goods. The war had made the monetary environment that made this class of assets more valuable than it appeared on the surface, and Buffett bought the spine of it. Think about what the commodity position is protecting against in the simplest possible terms. When a government goes to war, it spends money it does not have yet. It borrows it or prints it. Either way, there is more currency in existence chasing roughly the same amount of real goods. The dollar you have, sitting in a savings account, earning 0.5%, is buying slightly less of everything real with every month that passes. The commodity position is a counterweight to that process. Any asset that is genuinely scarce, oil, agricultural land, transportation infrastructure, productive capacity, and that cannot be created by printing, is a partial hedge against the dilution of paper. Buffett does not hold commodities because he is pessimistic about America. He holds them because he understands what funding a war does to the paper money supply, and he positions accordingly. So you understand the panic premium. You have the cash moat. You have the commodity position as an inflation hedge. The question that remains, and it is the question that separates long-term investors from everyone else, is what you do with the positions you already hold when the fear becomes overwhelming. And this is where Buffett's fourth principle is the most demanding, because it requires something that no amount of money can buy. If you have been trying to build real financial momentum, but keep finding that the theory makes sense, while the actual movement is not happening, check the first pinned comment below this video. It is there for people who are serious about closing that gap. What is the right time to sell a position you have held for years when a war breaks out and the market is falling? This is the question every investor faces in a crisis, and the honest answer most people arrive at is when the pain becomes too much, when the news gets bad enough, when the number on the screen falls far enough that the loss feels unbearable. Buffett has given his answer to this question in many different ways across his career, and the core of it is this. For your core long-term positions, the companies you hold because you understand the business and believe in its long-term direction, the right time to sell is almost never. The fourth thing Buffett did every time America went to war was maintain what functions as an immovable core, a set of long-term positions that were effectively not for sale at any price, generated by short-term fear. While he was actively adding through the panic premium, while he was deploying the cash moat, while he was adjusting commodity exposure, the foundation of his portfolio did not move. Not during the Gulf War. Not after September 11th. Not during the financial crisis, not during COVID, Coca-Cola, American Express, Wells Fargo, and later, Apple. These positions had one thing in common. Buffett understood the underlying businesses deeply enough that market price swings caused by geopolitical events were simply not relevant to his analysis of their long-term value. The data on what selling during a crisis actually costs is some of the most sobering in all of financial literature. J.P. Morgan Asset Management published an analysis covering the 20-year period from 2002 to 2022. In that period, the S&P 500 returned an average of 9.8% per year to investors who stayed fully invested. If you missed the 10 best days in that entire 20-year period, 10 days out of approximately 5,000 trading days, your annual return dropped to 5.6%. Miss 20 days and you are at 2.7%. Miss 40 days and your return is negative. And the finding that should stop you cold: 7 of the 10 best days in that 20-year period occurred within 2 weeks of the 10 worst days. The recovery comes right behind the crash. If you sell into the panic, you miss the recovery. Almost every single time. Buffett purchased Coca-Cola stock beginning in 1988 for approximately $1.3 billion. That single investment now generates more than $700 million per year in dividends, based on the original cost, not on today's market value. He has held it through every geopolitical crisis and market downturn since: the Gulf War, September 11th, the Iraq War, the 2008 financial collapse, the COVID crash. The price of Coca-Cola stock declined during several of those events. Buffett's response in each case was the same: nothing. The business sold soft drinks in countries around the world. It was not going to stop selling soft drinks because of a military conflict in the Middle East or a pandemic that would eventually end. The position was built to be permanent. Treating it as permanent was the entire point of owning it. Now here is the objection that gets raised almost every time. This time is different. The scale of what we are facing today, the geopolitical tension in multiple theaters, the debt levels, the monetary system under pressure, the political fragmentation. This is not like Korea or Vietnam or even the financial crisis. And I understand the instinct behind that framing. But here is what Buffett has said on exactly this point, across multiple decades. In his 2022 letter to shareholders, he wrote that he has watched America face extraordinary challenges throughout his entire life, and that his conclusion is consistent: never bet against America. Not because America is beyond criticism, not because crises are not real or consequential, but because the underlying engine, innovation, capital formation, productive capacity, rule of law, human ingenuity, has come through every challenge he has witnessed since 1942, when he bought his first stock at 11 years old. The immovable core is not a bet on any particular war's outcome. It is a bet on the long-term direction of the underlying economy. That bet, held without selling into the fear, has not been wrong yet across 80 years of Buffett's investing career. There is a behavioral element to the immovable core that is just as important as the analytical one. Buffett has described the experience of holding through major market declines as something that requires preparation before the decline happens, not during it. If you establish a position and think clearly in advance about why you are holding it and what would actually change your thesis, you are prepared to do nothing when the price drops. If you buy something without having done that work, every price decline becomes a question you are not equipped to answer. The immovable core is not stubborn, it is prepared. The test of whether a position truly belongs in your immovable core is simple. Can you explain, in 2 sentences, why the underlying business will be worth more in 10 years than it is today, in a way that does not depend on the current political situation? If you cannot pass that test, the position may not belong in the core. If you can, the price movements caused by wars, elections and crises are not signals. They are noise. And treating them as noise consistently is one of the rarest skills in investing. The four things work as a single integrated system, which is why understanding them separately is only the beginning. The panic premium requires the cash moat to be operational. If you do not have deployable capital when fear opens the discount, the insight is useless. The cash moat requires the discipline of the immovable core. If you liquidate your core holdings to build liquidity, you have just become one of the panic sellers generating the panic premium for someone else. The commodity position provides the inflation hedge that protects the entire system from the slow erosion of purchasing power that every wartime spending cycle accelerates. Pull any one element out, and the structure weakens. Combine all four, and you have the framework Buffett has used across 6 different conflicts spanning 70 years. Right now, as you watch whatever is on the news today, whatever conflict or tension or market headline is dominating the screen, every one of these 4 principles is active. The question is not whether a crisis will come. The question is whether you will be structured to respond to it the way Buffett does, or the way most people do. The panic premium is opening or will open. The question is which side of it you will be on. Now you might be hearing all of this and thinking, that sounds right for someone with his resources. His starting point is not my starting point. His financial cushion is not mine. I want to push back on that directly because it misunderstands what Buffett's actual advantage is. His advantage is not capital. His advantage is structural clarity, a framework that tells him what to do before he needs to do it. The first time he applied these 4 principles, he had less money than many people watching this video. He was calculating the intrinsic value of Washington Post and buying it at 30 to 40% below his estimate. He was 20 years old. He had almost nothing. The framework came first. The capital was the result. Buffett has said this in one form or another throughout his career, but the version that cuts through the most cleanly is the one you already know. Be fearful when others are greedy, and greedy when others are fearful. That sentence is not a motivational poster. It is a behavioral prescription, a precise description of what to do when the bombs are going off and the market is falling and every instinct in your body is telling you to run. The next time you see the news headline and feel the familiar pull towards safety, you will have a choice. You can respond the way most people respond, or you can look at the 4 things Buffett has done every single time this has happened before, across 70 years and 6 conflicts, and ask yourself which side of the trade you want to be on. The pattern is documented. The playbook exists. What happens next is up to you. If you stayed until the end, write in the comments, I am on the right side of history. There is another video on your screen right now. The next step in understanding how money actually moves during the moments when everything seems to be falling apart. Thank you for watching. We will see you in the next one.